So let's start out with just this pretty big accusation. So Madoff-style Ponzi scheme, that is what you guys are saying. It's a fairly extreme language. Can you break that down in simple terms, why you believe that to be the case?
Yeah, absolutely. Just stepping back, we use the Madoff and long-term capital management language in our piece because we found it to be the most apt analogy to events that have transpired in traditional financial markets. It does seem apparent that in crypto, a lot of people throw around the term Ponzi pretty liberally. But by definition, a Ponzi scheme must guarantee a return to an investor and use incremental investor funds to pay off earlier investors. And it is apparent to us that contrary to Celsius, which was obviously imploded around the same time, that was a little different. Celsius was taking user funds, rehypothecating them into unsustainable yield farming applications such as Anchor. I believe they also lost a considerable sum to a Badger DAO hack. There might have been a couple of others, but Celsius was more of a instance of just complete mismanagement of user funds and reckless leverage put into some of these Ponzi-nomic-driven yield-bearing applications. Three Arrows was a case of getting caught in a bad trade, first and foremost. Obviously, and to be clear, we don't know any of this for sure, right? Until we see 3 Arrows books and hear from them, it's impossible to be certain about any of this. But we know that they were big in the GBTC trade when it was trading at a premium. We know they were still in GBTC when it switched to a discount. So one could reasonably ascertain that they were stuck in this trade, and instead of managing that risk, they doubled down, likely fabricated results to prospective lenders. And given their reputation, on Twitter and just throughout the entire crypto ecosystem, they were able to swindle otherwise reputable lenders into giving them money, many times unsecured. I think the most Madoff-esque part of this whole situation is the fact that they were actually also making private investments, right? So they were investing in applications and in early stage venture type projects, and they would actually manage the treasuries of these projects and for a guaranteed return on these treasuries. So I think the combination of fabricating results to prospective lenders combined with offering these guaranteed rates to protocol treasuries, that definitely falls into the Madoff category.
So, with a lot of these imploding crypto products, there's kind of a mix of, as you're saying, allegations of just misconduct or illegal behavior, but also a lot of them were sort of acting in a regulatory gray area. And I guess the question is, for 3 Arrows Capital specifically, what might have been able to be done to have prevented this? Is there if there had been, for example, better regulation in place, could we have maybe seen a different outcome? Or is this just more of an example of a group of actors just kind of acting illegally, and it wouldn't have mattered, if regulation was stronger or not?
Yeah, honestly, I think it's the latter. There are fraud protections that are in place to protect consumers from these types of events, and to protect limited liability companies from these types of events. And we see the existing legal framework being played out now with Voyager filing for Chapter 11. I
can't hear you.
There is a framework right now for regulating centralized entities. This is just the markets reaping the consequences of some really reckless decisions made by centralized entities, and this is how it would play out in traditional financial markets as well. And to be clear, I think there is a lot of I alluded to this earlier, but there's a lot of I think apples and oranges comparison between this and the whole UST Terra implosion. I mean, this was a case of this same. This had very little to do with DeFi. This had everything to do with human nature and reckless lending and trying to make it all back in one trade. As I'm sure a lot of investors here know what I'm talking about when I say that.
So, like, regardless of whether this, we can label this as a Ponzi scheme, which you say is a very big allegation, or Madoff-like, whatever. I mean, it does seem to me that part of the problem has been the ongoing ethos, the number go up concept, that there was always going to be gains to be had, and that in some respects, the yield that was promised by many of these lenders was built upon that predicate, like, in the sense that there was a lot of arbitrage going on around that, but all these arbitrage strategies that required lenders to be part of that were themselves built upon the assumption that at the end of the day, crypto would keep rising. And therefore, in some respects, it's a kind of a collective guilt of expectations. Is that a fair comment? And how do you tease that apart from something more specific like reckless lending as you just described it?
Yeah, no, so I think an element of this is, I would say, the reckless utilization of these protocols that supposedly offer risk-free yield. That enabled a lot of this lending to take place. A lot of these, retail-facing platforms that would take user funds and deposit them into these protocols and pay out a very dependable and it was marketed as risk-free. But as we've written in our research about constantly, if you don't know where your yield is coming from, you are the yield. So I think moving forward, there's going to be a lot more scrutiny around the sources of yields, especially as they're paid out to consumers. I think this is also going to put a real focus on, bringing real, real world, so to speak. When I say real world, I mean the physical world, real economic production in the physical world onto these decentralized platforms, these decentralized applications, such that there is a sustainable, real source of yield for some of these borrowing and lending protocols. And just to go back, I think for speaking specifically about Voyager here, obviously I think they did pay out yield to retail consumers. I would just caveat the fact that they were also an exchange and had another business on the side. And this bankruptcy specifically, I think, is more has more to do with just the 3 Arrows and their reckless borrowing. But there absolutely is some more scrutiny that needs to be paid to yields in general.
Yeah, that did seem to have a very, very outsized position with 3 Arrows. Shifting gears a little bit here, later on the show we'll be having a guest on to talk about staked ETH and its depegging from Ether, which is a sort of a nerdy but nonetheless very important part of some of the breakdown we've seen broadly in markets here. You guys have a report out looking at the prospects of the merge, which is Ethereum's move to a proof of stake model, which would resolve some of those liquidity issues around staked ETH. Can you break down what you see happening and how likely is that to happen anytime soon and free people who are trapped in these trades right now?
Yeah, so to back up and just quickly educate folks on what's going on in the market as it pertains to STETH, going to call it STETH from here on out. It is a dynamic that's actually very similar to GBTC, where you have the derivative asset being this GBTC security trading at either a premium or a discount to the underlying net asset value. In this case, you have people locking up their Ethereum to the beacon chain and receiving a derivative asset that is, regardless of market conditions, will at some point be redeemable for 1 Ethereum. Given the fact that 3 Arrows was a large holder of STETH, we did see a lot of selling pressure of STETH, driving a considerable discount between the between NAV and of ETH and STETH. which has caused a chain reaction in a number of different ways, for people using ETH and DeFi as collateral. Obviously collateral, as the ETH price falls and the discount widens, there is a, on-chain margin call, so to speak, on this ETH. And we expect as we get closer to the merge and get more certainty around it, and perhaps even the macro outlook improves, we're going to see that discount compress, and 1 ETH will equal 1 ETH. As it pertains to the merge, the process right now is shaping up such that there's a considerable probability of it being completed in Q3 or Q4 of this year. The major steps being, 3 merges, testnet merges. 1 has been completed. 1 is in the process of being completed. That's the Sepolia testnet merge. And then after that, we have the Gurley testnet merge. And following that, we can expect to see Ethereum mainnet merge. Obviously, it's a fluid situation, and subject to, developer feedback, we'll have a better assessment on timing. But right now, we already see, some of the derivatives market start to price in a, end of September, early October merge. We see a spike in, volatility term structure around that time frame. And we think it could be a very good opportunity to leverage that investors should leverage.